All right, welcome back. Once again, chapter 3. Again, even in its title, it says additional customer transactions. So, once again, we will be dealing with our customers because, again, the first time we saw a look at our customers, we only focus on one aspect, and that is to be able to realize how we are able to produce a sale, right? Produce an invoice or a sales receipt, right? How do we enter in a sale and have it recorded in QuickBooks? That also came with understanding customer discounts, right? Now, in this case, right, since this is additional customer information or customer transactions, there's still a lot of things that we have to do with a customer. All right, and if you went over this again, it's this chapter is again very, very short compared to chapter 2. So, but there is a lot of information, just as much as chapter 2. Okay, so again, if you're following along with me in the book, you do have to open up Customers 21. All right, right here, every chapter reminds you which file to open up for every single chapter, okay? So that means every single chapter has its own document or its own file for you to be able to complete the task. So once again, of course, when we dive right into the very first thing is that, well, what happens when a customer decides to return an item or have us create a customer refund / credit memo, okay? So this is where I use that terminology, credit memo. Make sure you are aware of the difference between a credit memo versus a vendor credit, okay? Again, I mentioned this earlier, in real world terms, you can use a credit memo for both a vendor and a customer. But in this particular book right here, it wants you to make sure that you know the difference between a credit memo versus a vendor credit, okay? And a few things here too is make sure you know the difference, because when we issue these things, I don't want you to be looking for a credit memo under a vendor, because it doesn't exist, okay? It's only refunds or credits, but it's not an actual credit memo, where in QuickBooks, when we're dealing with a customer, there is the actual word credit memo. Okay, so here are the some reasons that we would use a credit memo. Okay, so one, if a customer decides to return merchandise to the store, okay, that's number one. Okay, other ones could be if you recorded an overpayment from a customer, or if a customer just is unsatisfied or wants to redeem something from you. Usually that's what a credit memo does. If they request a discount from you, that's where a credit memo will come into play. Okay, so again, make sure you know these reasons here, but there's also other means of using a credit memo, and that's what we're going to learn today, is that it's not just only strictly for just recording customer credits or refunds or anything like that. In this case, when we dive further down in the chapters, we actually use credit memos in order to write off bad debt, okay? But for now, let's focus on the main idea here, which is just looking at what happens when a customer returns items, okay? Because that's the most common thing, right? When we talk about selling a product to a customer, we cannot always satisfy all of our customers 100%. There's always times where someone will have an issue with the product. It could be a gift and they don't like it, so they're just returning it. It could be almost anything, all right? Or maybe they see, oh, hey, I did my research, you guys price match, right? And then et cetera, So there's a lot of different reasons why we would be using a credit memo, because once again, just us being able to have the possibility to sell a product, that means we have a high chance of having that product sent back to us. Now, of course, depending on what your company policy is, most cases, a lot of boutique shops, right? Once you buy something, it's final sale. You can never return it back, or you just get store credit. That's also the same thing here. You can issue it as a store credit as well. And we'll talk about the options of what you can do when you actually have the credit available for the customer to use. You either have a couple options that you could choose from to either refund the customer, have it available credit, or just apply it to their invoice. Okay, and we'll talk about that right now. So number one thing here is the example is that Mr. Bob Mason decided to go ahead and return something to us. So here we're going to be looking up Bob Mason, and we're going to be looking at his invoice number 3947. Okay, so once again, we're here. Now, there are many ways that we'd be able to view this refund for a customer, right? On the home page, you have it right here, refunds and credits. Okay. Now, if you click it this way, it's going to be generic, right? You don't know who is going to be requesting that. You don't know what. All right. Now, the best way, of course, is when you have a customer come in and try to return something to you, you know exactly who they are, unless it is one of those people who came into the store. You don't know who they are. They're just walking by, or they're just a regular customer, and you don't have any information on them. Then yes, that'd be perfect for the refunds and credits window right here on the home page. You can also do that as well if you go to your customer's menu bar, except this time it's not going to be refunds and credits. It's actually going to be under create credit memos /refunds. Okay, so that one's slightly different. Okay, and of course, any way that you can get to the home page, the customer center, you have those three exact ways too, right? Your new transaction, create credit memo, right click on anybody, and you'd be able to create a credit memo. And then, of course, manage transactions down below. Okay, manage transactions. You can create a credit memo that way. Okay, but in this case, right, we know exactly who is the one that owes us the money. Now, of course, the best way to do it is actually, again, when you actually know who is going to return something to you. So we know for a fact that Bob Mason is trying to return something to us, right? We're going to locate his invoice 3947. Okay, so when I pull up his invoice, it says he already paid for this. Okay, so that means we already know what our options could be. We are mandated to have to give his money back. Okay, now let's take a look at his invoice. Right, he purchased 30 photo papers from us. Okay, and the best way to go around this and refund or reissue a customer's stuff is that, yes, you should always do it this way, just so then it makes it that much more easier. Because if you don't, and you decided to use the refunds window on the home page, unfortunately, you're going to have to type everything in there. Of course, you're going to associate who the person is, and you're going to type in the exact invoice number and everything. But in this case, right, we already have the invoice. And if I go up to the top of the window, which is the sixth way to enter in, you have the options right here to do create, or in this case, refund/credit. And if by doing it this way, right, what's going to happen is if I click that, it's going to create a credit memo and it's going to copy all the information into my window without me having to do anything. So if you really want to save time, maybe go into, if you know exactly who's going to be returning, then you could go ahead and do it this way. But again, if it's a regular customer that just happens to just come in and say, hey, I don't like this product, here, can I have a refund? Then that's where you're going to have to type everything in and actually create that refund. Okay? Now again, so now that I'm in the window, Mr. Bob Mason, well, he's not returning all 30 items. He's only returning 10. Okay? So that's what's cool about this is that we can actually go in here and modify what he's actually refunding. In this case, he's not going to refund all 30 photo packages. He's going to refund only 10. So I could go in here and modify it because and type in here and say he's getting a refund for only 10 of them. Okay? And that's going to recalculate everything, and because he was taxed, it's also going to also calculate the tax that was charged on him. Okay, so again, you don't have to do anything except for fill in the information. Okay, now once again, as you can see, a lot of the information is already filled in for you. Now they do recommend this to do this as well, is that when you have a credit memo, they do want you to have a reference for the credit memo number. Now, most cases, as you can see, it automatically created another invoice for me. But in this case, the best way to be able to keep track of credit memos is associating it to the actual invoice number itself. So if you guys remember, I selected invoice number 3947, okay? And because this is a credit, they always say, well, you should always refer it with a C. So you know that this credit memo is associated and it's linked to this particular invoice, okay? And I believe, let's see what the date says here, since it copied the date over, or in this case, this is today's date. You want to make sure that the date is going to be, I think it's February 15 is when I am issuing this statement or this credit memo, okay? And again, now C is not going to be something that you guys are obligated to do. It could be R for refund, right? But they just make it C so then it's easy to understand this as a credit, right? Again, it's whatever method that you guys understand how this works. If it's an invoice and you're trying to do a credit, maybe you do the invoice dash a number, invoice dash something. So again, that is subjective, okay? And now that everything looks good, of course, we still want to say thank you for your business, right? Because even though they return a product to us, you still want to be nice, right? And then the memo, you're going to say, refund 10 photo packages, okay? Oh, photo papers, excuse me. Okay. So again, because this is the cool thing about QuickBooks is it already associated that you have to give tax back. So when we do issue what the person everything, it, in this case, behind the scenes, because this item is a taxable item, it's also going to deduct this amount of tax, so $10.20 worth of tax automatically for you, okay? So once again, let's go ahead and everything looks good and save and close, all right? Now, this is what I was talking to you about. This is the available credit window. These are the options that you could do when it comes to issuing a refund, right? in this case, because Bob Mason, right, I made sure that you guys recognize that he made a payment. It's been done, it's paid for. So therefore, our option to apply it to an invoice is not going to work because he already paid for it. So in this case, that's not an option that you can do, but obviously it is an available option. However, you have the option to either, one, give a full refund, so that means issuing them a check so they get their money back, or you do have what's called apply as an available credit. So this is where, if you're familiar with store credits, this is what an available credit is, to making it available so then when this person decides to purchase something from you again, they have a credit that they can apply to whatever they are purchasing, or same thing, right? You issue a store credit card. They use it, right? And that's a tactic to keep your customer coming back to your store. So that's the available credit right there. But in this case, yes, we are going to be giving a full refund, okay? Because he paid for it, so I have to issue him his money back. So what's going to happen is you're going to get this second window where it pops up and it says, well, okay, so you're going to give Bob Mason a grand total of $133.80, right? What's your preferred method to give back the money? In this case, right, straightforward, most common way to issue money back is by sending a check. Okay, right there, it's already selected that we are going to be giving back a check, and it's coming out from our checking account, right? That's how we deposited it. So in this case, it's going to come directly out from our checking account. So then here you go, Bob Mason, $133. The date, so remember, the date says it's February 15. Now again, if you're mailing this out, you definitely don't want anybody to intercept it and be able to cash it out or fraud somebody to cash it out. So you definitely want to make sure that if you want to, you can always say, well, since February 15th is a Monday, I'm going to assume that it's going to take at least 2 to 3 business days. So I'm going to make it available for Friday, the 19th. So then when he actually receives it, then he can cash it on Fridays. All right. Now that's what most cases, a lot of professionals do, is that they never put the actual date for it to be available. They wait a couple of days because they don't know, right? There could be a storm coming in California where the mail could get lost. Whatever reasons, right? So you always want to make sure that you extend it a couple of days out. But if you're like that person where you don't really care, you're just going to cut the check and want to just have it sent out automatically, then you can do whatever date that you like. Again, class is San Jose because this transaction was done in San Jose. Again, Bob Mason's information is here. And then here, what is this memo right here? Okay, this 402613. Again, if you don't want to use English, right, you can set up some kind of code, digital code, or not a digital code, excuse me, a digit code is what I meant to say, where you could, if you look at this, you could tell that okay, this is a refund. Okay, so again, that's only if you use codes, but in this case, I'm actually going to make sure I write here that refund for 10 photo papers. Okay, so once you've done that, you want to make sure it is a check. Okay, everything looks good. Again, you want to make sure it says it's to be printed later, because I don't want to deal with the check right now. I wanted to do it later because I have to sign the check, I have to assign the check number, etc., etc. So in this case, everything looks good, and I click OK. Right? And I get that beep of approval. And then notice this. When I go ahead and take a look at my invoice because let me show you this. If I close out my window, since I'm under Bob Mason, now let's look at our transaction list, right? This is for all of the transactions. Here, you can see right here that the invoice number 3947, because we didn't apply to the invoice, the credit memo, this is still the same way it is. It still says it's paid. It still says it's $401. However, let's take a look here. We have the 3947C, which is our credit memo, which tells us it's a negative 133, and boom, we wrote a check out. Okay, so this gives you pretty much a great synopsis of your transaction list right here. Okay. So, any questions in regards to issuing a refund for a check?
Not about that, but just double checking. You are recording, right?
Yes, I am.
Thank you.
I'll even double check for you. Yes, I am.
I don't have any questions about the actual refund. I just have questions about, are you using February as like a default month and not for today?
Okay, so this because let's see, let's take a look. So in your book, it's because, this transaction happened as of the December 18th. So wow, we gave him a 2-month refund. Your book just basically tells you that you should just give your refund the day, whatever date that it's in your book. It's because, again, I could have taught this back in December, or I could have taught this back in February, right? And then that way it would be more up to date. But because this is September, right? It would be best, especially for your customers, again, if they, you would use the date that they actually come in and they actually return the item to you. But because QuickBooks is using real time, as in every time I open up QuickBooks, it's going to automatically say, right, today is September 15th. No doubt about it, today's September 15th. And that's okay, and that's why I'm saying oftentimes is that because this is a lecture-based type, I'm just teaching you whatever the book says, okay? But in real time, if you are doing this on a real business and you do have that customer do come in today, then yes, you would use that date for today, okay? But once again, it's just because QuickBooks is saying, oh, you're doing accounting real time. It's gonna automatically always pull up today's date, and you're just gonna have to toggle it. Okay.
Okay. And then my only other question was, so when we went to the actual save and close,
Mm-hmm.
and it says to choose select give a refund or apply to an invoice,
Mm-hmm.
is that something that we would do based upon what the customer wants
Yes,
or what?
yes,
Okay.
and no. So it's also against the company policy too. Let's say like no, you missed the return date, then you're subject to have to give him an available credit. So in this case, I could have given him available credit because I didn't know that I charged Bob Mason in December. My company policy is probably refunds in 30 days or something like that, right? It depends on your company policy as well.
Right.
And if they
Okay.
haven't paid, okay, if they haven't paid, then that kind of gives you the option to choose between either apply the invoice or apply it to or give them available credit. Most cases, if they haven't paid yet, what you're going to do is, and we'll take a look at it in a few minutes, you're going to reissue them a new invoice with an updated amount because, again, the customer's going to be like, whoa, why are you charging me all this money when I told you I didn't want this? So there's a lot of issues. So it depends on the customer and what the aspect is of the situation. But most cases, it's not what the customer wants. But if the customer wants their money back, then yes, issue it. But if you have that store policy where you say, hey, no, you can't get your money back, you can only get store credit, then you would have to put it as available credit. So it just depends on the situation and what you think is best for that customer.
Okay, thank you.
Mm-hmm. All right. So that was issuing a refund for Mr. Bob Mason. Okay. So another one here we have here is going to actually be doing a credit memo for any credit card transactions. So if you guys remember yesterday, we actually had Maria Cruz, right? She paid all 3 bills with one credit card transaction, right? If you guys remember, let me see if I can pull it up, that she paid all 3 invoices, which totaled up to a total of $19.50, and she charged it on her credit card. Okay, where is Maria Cruz? So if I pull up on it, so here's the payment right here. I can obviously pull that up, right? Here's the payment. Okay, she paid all, okay, in this case, she paid all 4 invoices, totaling up now to a completely different number than I said earlier, right? So $19.50, all right? Now, in this scenario, she used a credit card, right? It says right here in this case, she used American Express, okay? And she paid all 3 transactions, okay? Now, that means the paid services is already done. So how do we issue a credit memo because she paid with a credit card? It's obligated to go back to her credit card, right? Unless you save it for unavailable credit. But let's say she wants her money back, okay? And let's say you, for her scenarios, right? If you look in each and every single one, she ordered a lot of people to be there. She had a couple photographers there. So that's the situation here, is that we need to create a credit memo for Miss Maria Cruz. Now again, you could choose Maria Cruz and be able to create a credit memo this way. There's no particular invoice that she's returning because she paid all 3 invoices, right? You can use the home page, right? You just enter in the person's name, and you just enter in what the item that they are actually refunding for. So again, let's do that example right here. So I click refunds and returns, right? Like I've mentioned before, it's blank. I got nothing. I have to fill in everything manually. All right. So again, who am I issuing this credit memo to? Maria Cruz. Now, it doesn't have to be branch opening, but let's just do Maria Cruz. Maria Cruz, I believe, I think she belongs to San Jose, if I'm not mistaken. Maria Cruz, okay, so we have a specific invoice that we are returning, which is going to be invoice number 102. So in this case, there is a specific one that we're looking at. But in this case, I'm going to show you how to just use the home page and how you have to manually add everything in there. So in this case, the class, I think she is a San Jose location. The date, again, is going to be, since I already toggled the date here, it's going to automatically associate, okay, then you must be doing as of February 15. Now, in this case, the book tells you that it is February 15. All right, and then what we have to do here is we have to, see, now it shows you, hey, that means you're doing 3948C. No, this is for invoice number 2021-102C. Okay, that's what your book says. With that being said, So let's go ahead and enter in what is she actually refunding. In this case, right? She had a bunch of photographers that came to her her photo session. However, maybe 2 of them called in sick. Okay, they called in sick, so therefore we have to reimburse her because we charged her for all of these. I believe we charged her 6 photographers, and 2 of them decided to call in sick and could not make it. So in this case, I had to refund her for those photographers, okay, because she already paid for them. So in this case, right, tax, because it's a service, right, quantity, since each one cost me 125, 2 of them called in sick, so therefore it's going to say, well, I have to refund her $250. And because it's a service, right, you can't tax services, okay? You can only tax products or special items. So in this case, I have to issue a refund for $250. I would have to also say, well, thank you for your business anyways, or you can write an apology, right? I apologize that 2 of my photographers did not show up. So here is your refund. Whatever you want to say, right? Your memos, whatever is subjected to whatever you want to keep your customers to keep on coming back. And a memo, once again, is going to be refund for 2 photographers. Okay? And of course, you're going to also make a note here because she paid with a credit card. So that means I'm going to make a little note here saying American, so AMEX, I think is the short term for American Express, credit card refund. Okay. So now that I put that in there, all right, everything looks good. Again, not taxed because it's service. So that means I am going to be refunding Miss Maria Cruz. So once again, if you are using the refunds / credits window on the home page or anywhere else besides actually going into the invoice and clicking it, you're going to have to manually enter in everything, just like how I just did it right now. There's no association, even if you type in the invoice. No, there's no association. Unless you know the particular customer and the particular invoice, you can save time by just open up the invoice and clicking on that refunds and / credits. That's just to help you save time. In this case, I'm showing you an example what happens if you don't use that. You would have to fill in everything manually yourself. Okay? So everything looks good, and I'm going to go ahead and click Save and Close. Now, here is where it says, what do you want to do with this? Now, as we've mentioned before, she's already paid for this invoice. So you are obligated to have to give a refund, or again, if she's like, no, just I'm going to use your services one more time, or whatever, right? Now, in most cases, she already paid for all the invoices. So there is no invoice to apply to. So in this case, we are obligated to either give her a credit or give her available credit. In this case, she wants her money back. Most cases, credit card transactions are 100% going to go back to their credit card. Okay? And I'm going to go ahead and click OK. Now, again, you get that same exact window, but here's the difference. You are not going to issue her a check because she paid via credit card. So if that's the case, then of course she should be expecting that money back to her credit card. So she charged her American Express, and this is where it's going to say right here that you're going to be refunding to Maria Cruz $250, okay? Again, you want to make sure confirm all the information, and look, now I still have that code there. I'm going to go ahead and write reissue refund for 2 photographers on American Express credit card. Okay. Now, here is where you can actually have a paid service, okay? This is a subscription that Intuit actually offers. So your book actually goes into detail, not into too much details for this, but it does let you know that if you paid for an Intuit paid services, so the service is going to be QuickBooks Payments, okay? By clicking OK, and you clicking this button down below, process the credit card payment or issue the credit card. This is only available if you have the actual QuickBooks payment subscription. Okay, so yes, and it will automatically do it for you automatically, right? You just click OK and it will automatically issue the money back to that person's credit card immediately. Now, of course, since this is, a student version, of course, not everything's going to come with subscriptions, for free. So in this case, what we cannot select this because we don't have the paid services. We would actually have to manually send that money back. And how do we do that? And that's what I'm going to show you here because we don't have the paid subscription. All right. So in this case, I'm just going to ignore this part right here and I'm going to click OK. All right. Once I get that beep of approval, right, I'm going to make sure that I do see that credit memo before I show you what to do next. Okay. So Maria Cruz, okay, we pulled up her information and says, yes, we did issue her a refund. Okay. Here's the credit card refund right here. Now, we didn't actually do it yet. We just recorded that we issued them her credit card money back. Now, in this case, right, how do we manually do it? Same thing here because in our books, it doesn't reflect that because we didn't pay that service fee. Now we have to manually do it. Now, as you can see here, look at my record deposits. It's highlighted as one notification. So if I go ahead and click that notification, this window will pop up saying, this is exactly what we're doing. We need to return money to Miss Maria Cruz. It says it right here under item or the type here. It's a credit card refund to the American Express to Maria Cruz for negative $250. So that's why we have to manually enter this in so then it updates our checking account because we may say that we issued it, but we actually didn't physically issue it. By doing so here and selecting this and clicking OK, and by us processing it here, right, negative $250 and clicking Save and Close, now it's been done on QuickBooks end. Of course, you do need to set up in reality, right? You would actually, the bank would actually automatically do that for you, right? You just make sure you tell the bank that this person is making a refund so they issue it to the correct account, okay? Again, anything that you do in QuickBooks, it is not linked to your bank account, but we will talk about that in chapter 5, okay? You can link it to your bank account, okay? So that's how I would process a credit card refund, and by reissuing it, by manually saying I'm actually going to issue it by forwarding it to her credit card. Okay. Any questions here?
No. Will we need to know that, how to do it manually?
I mean, honestly, I can't tell you what's going to be on the certification exam. Yes, they gave you a study guide and to guide it to your reading, but every time you take the certification exam, every student that takes it is going to have a different exam, unless you take it on the same day, of course. But every time you take an exam, it's going to be different every single time. So I don't even know if you're going to get the same questions as I did. You know what I mean? I don't know if you're going to get the same questions as Sonia. I don't know if you're going to get the same questions as someone else in this class, right? Because every single time you take a certification test, it's going to ask you different sets of questions. So is that something you need to know? Well, if it's in your book, then yes, I would definitely recommend you knowing that. Okay, because again, this book that I'm teaching you guys is in regards to actually certifying for the actual exam itself. Okay, so strong recommendation, especially if you are perhaps planning to use QuickBooks in the future, then yes, that would definitely be something you should know. Okay.
My only question is, did she not actually get a refund because you said you would teach us, or we would have to link it to our bank account. So did she not really get a refund?
Well, in this case, because we're not focusing on the bank account right now, um, in this case, yes, because in QuickBooks, right, you are just updating your own personal books. Whatever you're doing in real time, like that's dealing with a real bank, just like when you void a check on your QuickBooks, the bank's not going to know that. You would actually have to call the bank and say, "Hey, I voided this check." But we'll learn in chapter 5 that we have what's called bank feeds, where you can actually link your bank account to QuickBooks. So yes, you can do online banking. You can do all your online transactions right then and there in QuickTimes in real time. So yes, you can. Yes, you can.
So like QuickBooks, so like QuickBooks for Business is pretty much like um, keeping track of everything on paper, but not on paper,
Correct.
business wise.
Correct.
Okay.
Mhm.
Okay. Thank you.
Mhm. All right. All right, so let's check out the book real quick. I mean, I already know what's the next section. So now that we talked about customer refunds and creating credit memos, the last section that we have here, or dealing with credit memos, is going to be looking at how to write off bad debt. Okay, so let me find that page real quick in the book. I think I missed. Oh, here you go. Writing off bad debt. Now, of course, if you have or allow your customers to owe you money, you are subject at risk because, again, when we are dealing with customers, right, we're dealing with customer service, providing the best products for a customer, right? We want customer satisfaction. Okay. However, we're doing our part as a company to try to gain those customers, right? But again, we can't trust 100% of all customers, right? Because we don't know what their given financial circumstances are. Okay. So again, maybe they lost their job, so they can't afford to make the payments. Maybe they moved out of the country. You can't pay your bills if you're not in the same country. Well, you can, but yeah. Anyways, what I'm trying to say is that there are many circumstances where sometimes a customer just won't pay. And even you have some people out there that buy your product, want to return it, and if they don't get their money back, they get angry, and they said, I'm not gonna pay for it," or they're gonna just say something like that. Okay, because again, the ultimate goal is that customers, yes, they have that connotation where the customers will always right. So in this case, right, if you do end up having your, customers allow you to owe you on an account, that means you are also subject at risk that a customer could not comply and not pay you. So with that assumption, that's where this little feature here where it says to write off bad debt's going to come into play, because especially major corporations, right? Give an example with Walmart. How many billion people do they allow them to owe them on a credit card? A lot. And again, there's many reasons why a certain person can't make their payment, right? Due to anything that happens to them. Okay, maybe they switch jobs, maybe they lost their job, maybe they're moving from another, state or another country, right? They can't afford to pay for it, or they just don't want to pay for it. Simple as that. Therefore, that means for the IRS, they allow all businesses to take up to 5% as a loss to the company, because the assumption is that it's also another task or a difficult job to go after people and become a debt collector, right? So I don't know if you know any recent changes, but Walmart has actually sold their accounts receivables to Capital One. Now Capital One is control of everything, and they are. And when you have that person or another person take care of this debt collecting, right? That means you can imagine Walmart paid them a lot of money to collect the money. And again, if each individual that owes a credit card for Walmart, right, they're being harassed by a debt collecting company, a credit card company, to try to pay their bills on time. Okay? So that's the same idea here, where it's a huge job on their own to have to go after these people to collect debt. And when you come to a conclusion where a person just refuses to pay, or if someone filed for bankruptcy, well then great, I can't ever collect money from them. And that's the assumption where the IRS allows the all companies to take up to 5% of accounts receivable and realize it as a loss or bad debt. Okay, now that 5% is for every single year. Okay, so that's even crazier, right? So then that means you don't even need to make money, or you can just sell your products. But that's the thing, that's going to hurt your business because you're not getting the money you need to be able to operate your business. So it is a double-edged sword when you have that 5% forgiveness, but at the same time, you need that money to be able to operate your business. Okay. So again, that's a little fun fact for you. But in this case, how do we write off our bad debt? Now, in this case, because QuickBooks, I don't know if I mentioned this before or in chapter 1, it is actually created for two purposes, right? And the primary purpose is actually to make it easier for you to file taxes, right? If you remember when I told you, Intuit also owns TurboTax. So if you're able to use QuickBooks and transfer all the information to the TurboTax, it makes it that much more easier to file taxes. Am I right? However, the second reason is also for businesses to keep track of their income and expenses, right? Maybe they want to manually do their taxing, right? They don't need to use TurboTax or use another person for taxes. And that is exactly why I have to tell you this. In this book, since it's tax forward, or it's meant for tax purposes, that means they taught you how to do the direct write-off method. Okay? Now in accounting and the rules of GAAP, if you are not the tax accountant, no, you can't be doing this. That's not what you should be doing if you're not the tax accountant, because you're not the professional at taxes. Okay? So that means for rules of GAAP, they teach you how to use the allowance method. Okay? Now in this case, right, this is where I'm going to go off the books, because I need to teach you both, because again, for those who are sitting in this room, are you guys going to become tax accountants? Maybe not all of you, but that means at least you know something that you could carry on in the future with you, right? Instead of knowing only the strict rules of the tax part, at least you know how to do something as a regular accountant. Okay. Yes. So here I'm going to teach you the direct write-off method first, because that's what the book tells you in the first place. So let's go ahead and do this example right here. Okay. So again, direct write-off method is where you're actually going to write off your bad debt directly off of the accounts receivable. You're not going to give any chance or any opportunity for someone to be able to make a payment. Once you say it's done, or they're never going to pay you back, I'm just going to get rid of it and just say it's gone. That's what the direct write-off method does. Okay? Where the allowance method, right, it gives your customers the chance to maybe potentially, it's potential bad debt, right? It's where, let's say your customer missed their just one of the payments. That doesn't mean they're going to consistently make the next, they're going to miss the next payment, right? You might have to call them and give a reminder, hey, your credit card payment's due. Did you forget? And if they're like, oh my gosh, I'm so sorry, I'm going to make a payment now. That is where the allowance method allows you to give room for accountants and for customers to still make a payment, even though they could be potential that they might not ever pay you. So that's the difference between the direct write-off and the allowance method. Is one, you're taking it off and you're not even giving it a second thought. You're just completely getting rid of it right away. Where the allowance method, it's just potential bad debt. Okay? And of course, when you reach that part where it becomes potential bad debt, eventually that's when you're going to actually end up writing it off as bad debt at the end of a given period. If you exhausted with this customer for 2 years, then obviously 2 years is already long enough to know that this person isn't going to pay you. Okay? So again, let's go ahead and focus on the direct write-off method. So they usually recommend you to make sure that you have the appropriate accounts in the first place before you can actually do the direct write-off method. Okay? So first thing we have to do is, before we can even create an item, you need to also be able to have the account so you can link them. So in this case, I'm going to go ahead and type in right here, do I have a bad debt expense? And let's see. Yes, I do, right here. Okay, this is a bad debt account. Expense right here. Okay, account number 60,300. Perfect. I already have the account set up. So therefore, I can move on to the very next one, which is now creating an item. Now, we didn't talk about items, okay? So if I go to list, right, I can go ahead and create an items, or the home page, you have items and services. We will talk more primarily what items and services does, especially in chapter 8. So that's next week, okay? What items and services does is basically it's a list of anything that has to do with your sales process. So in this case, because we're writing off a bad debt, that's because someone doesn't want to pay us, and that dealt with a sales process, right? That dealt with something that had to do with sales. So in this case, this is what the item list is, and we'll talk more about in depth in chapter 8. Okay? So once again, here's my item list, right? This basically lists all my products and services, taxes, charges, discounts, and et cetera, et cetera. Okay? Now, in this case, they want you to create a new item, and they want you to create it called bad debt. Okay? So again, it's the same format as we've been adding, whether it's an account, an item, or something that's on a list. Same way. You're going to click down below. In this case, it says items, and you're going to click new. Okay? And then you get this pop-up window where you're going to fill it out exactly like what we've been doing always. Okay? So in this case, we need to create a bad debt item. Okay? Which, in this case, right, I believe it's an other charge. Let's see what your book says. It is other charge. Yes, other charge, bad debt, and this is what's going to be here. So it's going to be an other charge item. So in this case, I'm going to go through my list. Now, we'll talk about every single item type again in chapter 8, but in this case, it's considered an other charge. So when we locate other charges, there you go. They want you to create a bad debt item, so bad debt. Okay? And what you're going to type in here in the description is pretty straightforward. To write off bad debt on accounts receivable. Okay? And then again, it's going to say, well, how much is that? Well, how much is that? In this case, we don't know. We don't know what that bad debt's going to look like. And is this item going to be taxable? I believe no, it's actually a service. Okay. And what account are you going to link this to? Again, this is to the bad debt expense account. So all of this is right now not making any sense because we haven't talked about what items do, how do you link them to accounts, but this is how QuickBooks is able to do the accounting behind the scenes. Is because every time you use an item, you're linking them to the appropriate account. So it knows exactly what to do and where to take out and how to do the debits and credit system. Okay? So in this case, we'll talk more about this again in chapter 8. So I'm going to go ahead and click OK. So now you have a bad debt item that's right here. Okay? And now we are finally ready to go ahead and be able to write off our bad debt. Okay? So we're going to go ahead and take a look at an invoice. Okay? So we're going to be looking at Anderson Wedding. Okay, I believe it's going to be for Sati and Kumar let's see, Kumar, Sati, and invoice number 4003. Okay, so I'm gonna double click on this invoice for 4003. Now let's take a look at this. Notice this. We're looking at this invoice, right? Let's see, when did we issue it? We issued this since December of last year. Okay? And it says right here it's past due, so they haven't made a payment for over 2 months now. Okay? So therefore, let's see what they have. They had 2 indoor photo sessions, right? Costing a total of $190. Okay? So this is what you have to do when you are going to write off the bad debt. So this one is more particularly mainly for accounts receivable. So any invoice, so you have a record of this for you to write it off as bad debt. Anybody that is like a regular person that does a sales receipt, obviously those are cash basis people. You'll never write off bad debt off cash based people because they've already paid for their services. In this case, this person still owes me, and they've owed me for so far 2 months now. Okay? And what you're going to do here is you are going to be creating a credit memo off of this invoice. So this is where I recommend, instead of using the refunds and credits window on either the homepage or anywhere else, you should definitely do it right here by opening an invoice and then clicking the refunds and credits right here. Because once again, it pulls out all the information, and especially when we're dealing with a bad debt, you need to make sure that you have everything so you don't accidentally over or under, write off the bad debt. So in this case, here it is. My credit memo tells me right here that I'm going to be issuing this like this, okay? In this case, no, you're not going to. In this case, it's a bad debt. So again, I'm going to go ahead 4003. Okay, now in this case, are you going to use C? This isn't a credit. This isn't you're not refunding anything. In fact, this is a bad debt. So you can choose whatever way that you want to say here. So what I'm going to do is I'm going to put D for debt. Okay? And what's going to happen here is let's make sure we memorize this because, again, when we take it off, it's not going to work. Okay? So again, here we take a look. It's going to be for $190. Okay? So what you're going to do here is, in order to write off this bad debt, you're actually going to change the item into a bad debt item. So bad debt item. Okay? It's going to change all this, and it's going to say, hey, I hope you know you are linking an expense in this item. And yes, I am aware of that. Okay? And in this case, right, it is a service, and I'm not getting one. It's only one that we're doing, and it's going to be for the total of $190. Okay? There you go. So there you go. Now I've created my bad debt, and here it is. And then what I'm going to do here down below is, there's no need for a thank you for your business because you're not issuing this out to the customer. But the note that you want to place here is, since it says all this right here, right? I'm going to go ahead and say this to write off bad debt. Okay? Straightforward. And because the item is not taxable, so once again, if you do have something that is taxable, it's also going to write off that tax as well. It's going to undo the tax. In this case, it was a service, right? There was no tax involved. It was a straight $190. So therefore, boom. And then when I go ahead and click on this, save and close, this is where you have to pay attention, because I have to apply it to an invoice. Because if I don't apply it to an invoice, then I have an outstanding accounts receivable, and then I have a credit memo that has no association, right? So in this case, I must apply it to this invoice. And I'm going to click OK. Okay? And then it's going to say, well, if you're going to apply it to an invoice, are you talking about this invoice? And yes, I am. I'm talking about the invoice for $4,003. That's correct. So make sure you select it and click OK. Okay, or click Done. Okay? Now notice this. Look at the invoice now, right? It said that you owed $190, but then you got a payment or was applied, which discounted or took off that $190, and now the account balance is $0. And that's how you write bad debt off. Okay? So this person does not owe you anything anymore because they haven't paid for their services, and you've exhausted, trying to contact them, sending them letters, whatever reason that you try to send them all the information, right, to try to get them to pay you, and they're just not budging. And you just are preparing for your tax reports or whatever, and you're saying, well, this person isn't budging, so I'm going to go ahead and write them off. And that's how you do it. Okay? Any questions here? So therefore, I increased my accounts receivable, and by doing that credit memo and applying it to a bad debt expense, now it's undoing the accounts receivable, but by placing it into bad debt. Any questions?
No.
Okay.
Heidi,
Yes.
hello.
Yes.
Bad debt, it is loss.
Yes. It is 100% loss. Yes.
Thank you.
Okay. All right. I thought there was more to the question, but that's okay. Yes. And again, if I go to my chart of accounts, right? So my accounts receivable again has decreased, but let's take a look at my bad debt expense item. Okay, so bad debt expense account. So if I actually double click on it, I get a quick report right here. Shows me that I have a credit memo for that $190. So right there in the very beginning, because I never created a bad debt account, because I had to remove it and create it as a loss, it is now right here, right? And I removed it directly out from my accounts receivable. So again, if you're not a tax accountant, that's a big no-no. So with that being said, I'm going to also show you how to be able to do it if you are a regular accountant. So, same steps are going to apply, right? I need to create an allowance for doubtful accounts account. Okay, I need to create an account, then I need to create the item, and then I'm able to use it to apply it to the associated associated bad debts. So in this case, I'm already here on my chart of accounts, and I'm actually going to create a new account. Now, here is where it is tricky because a allowance for doubtful accounts, it is not an expense account because again, it is potential bad debt. It's not yet bad debt, okay? So in this case, what I have to do is I'm actually going to be creating another account, but in this case, it's going to be considered an other current, or in this case, an other asset, okay? You could do an other current asset. Again, I think that would be better, an other current asset, because it's accounts receivable, right? But you do have the choice between either other current asset or you could do just another asset. Because in this case, right, can you actually touch bad debt? No, you can't. So it does have that key feature where it's an intangible asset, right? So therefore, it could fall under or. In this case, I do have a specific one for other current assets, so you can do other current asset or other assets. In this case, I'm just going to go ahead and do other assets just because technically it's not a current asset or in other sorts. It's not, because what it is it's just going to be another account that doesn't exist as anything more than an other asset. I don't know how to explain it. So there you go, other asset. And I'm going to go ahead and click OK. Or sorry, continue. So how are you going to create it? So once again, you have this. The item is going to be called allowance for doubtful accounts. Okay, in this case, right, many different companies will refer this to bad debt allowance or doubtful accounts, anything like that. But they don't use bad debt for sure. They could use it as uncollectible debt. There's many different ways that you can title this, but at the end of the day, I'm just using allowance for doubtful accounts because that's what I am consistently using throughout QuickBooks and the accounting program. So allowance for doubtful accounts, there you go. And what am I going to put in my description? I'm going to say to write off potential bad debt or uncollectible debt. Okay? Straightforward, right? Do I have an account number? In this case, if I remember, I think my accounts for my assets are like in the 10,000. So I'm going to say this is account number 19990, whatever. Okay. And I'm going to go ahead and click. Okay, so here it is, right? The allowance for doubtful accounts. So now I actually have an account. So the next step here is I need to create an item. So here I go to click items and services on the homepage. And the same thing that's going to happen, just exactly how I created my bad debt item, I'm actually going to go ahead and click new. Same thing, it's an other charge. And this time it's going to be allowance. I can shorten it to allowance for doubtful accounts.
You can put that period in there too.
Yes, you can.
Oh, okay, cool.
And again, description to same thing, to write off potential bad debt. Okay. And again, now it's asking you, well, how much are you going to do it? Is it taxable? In this case, no, it's not taxable. Again, it's just a regular service, okay? And or in this case, you might, if you have taxable items, then maybe you should keep it as taxable, right? Whatever one that you want. Again, you can always toggle this. So if it's not a service and you are dealing with items that are taxable, you can modify it on the actual sales form. Okay. So in this case, right, account is going to be linked to the allowance for doubtful accounts account. Okay. And I'm going to go ahead and click OK. So now I finally have my item here. All right. So what I'm going to actually do now is, because I don't have an example, because your book only gives you one example, I'm going to go ahead and create a fake invoice. So in this case, I don't want to bother Bob Mason. I'm going to bother Tim Fang, because we haven't talked about him in a while, okay? Tim Fang. Let's say Tim Fang is from San Jose, okay? And let's say he bought something way back in October. Let's just say October 1st he bought something. Excuse me. So again, I'm going to say that this was $3,950. Okay, because I don't know. $3,950. And let's say he bought an outdoor photo session, and he bought 2 of them, okay? And maybe he actually purchased also, actually, that's fine, okay? He bought 2, and maybe a retouching package. I don't know. No, never mind. I'm being indecisive. So there you go. So 2 outdoor photo sessions, okay? Once again, thank you for your business, okay? 2 hours of outdoor photo sessions. Okay, there you go. Obviously, this item's not taxable. Okay, that's okay. And we're gonna go ahead and click save and close. So there we have we've increased our accounts receivable, right, by creating a transaction for Mr. Tim Fang. Okay. Now again, let's say, fast forward, it's March. Let's just say it's March 1st. It's been 4 months since Tim has not contacted us. We exhausted our means to try to collect money from him. He's not budging. So in this case, I'm going to choose to just put him as a potential bad debt, okay? Because I'm not done with Tim yet. I still think that he has a potential to still keep paying me if I keep bothering him. It's only to the point where I say, no, I've had enough, okay? So in this case, I pull up his invoice right here. He owes me $190, okay? So I'm going to go ahead and give him a credit memo. And this time, I'm going to cease to exist it as if he is potentially going to pay me later. So in this case, I'm going to put the date again. Let's just say, how about this? How about on February 1st, I noticed he missed his payment, or January. Let's do January, so it makes more sense. January, right? It's been October, November, December. It's been 3 months. And in this case, again, I'm going to make this reference as 3950D for debt. Okay? And as you can see here, the same thing's going to happen. Now, notice this. It's $190. So that's what I'm exactly do. I'm going to change this and make this the allowance for doubtful accounts right here. And I'm going to make the association that it is one item. It is not taxable. It's a service. Okay? And once again, it is $490. Okay? In this case, I'm going to go ahead and right here to write off potential bad debt. Okay? So once I see this, right, and it's $190, and everything looks good, I'm going to go ahead and save and close exactly the same way. And once again, I am going to apply it to an invoice because I need to remove it from my accounts receivable. Okay? So once again, here's the exact one that we're looking for. And I'm going to go ahead and click OK. Now, what's the purpose of actually doing this? Now, again, you definitely want to make sure that you keep your people separated, right? Those that are they're doing due diligence and making their payments, and then you have those who are potential to keep not making their payments. So that's exactly what we're doing here. If you think of it in context that way, right? What we're doing is we made an account receivable for them, and then now because they're not proving to pay it, we need to remove them from the account receivable and add them to another account. So basically, it's a placeholder account until they pay. And if they don't pay, well then, when you come to the cookie, so right now it's January, right? Maybe March rolls along. It's been almost 5 months, right? It's been almost 5 months since this guy's paid. There's no way that this guy's going to actually keep, there's no way that you need to waste your energy because it's only $190. That's not that much compared to other people who've done services for up to $2,000. It's just a mere only $190. That should be okay to just be safe to write off. Okay? But let's go ahead and take a look at the chart of accounts one more time. Okay? So again, because we associated this bad debt or this allowance as an other asset, okay, therefore it's still considered an asset because he has room and potential to pay. So if I go ahead and click this or view it, it says now, right, earlier I increased my accounts receivable, but then I decreased it because I used a credit memo and it dropped it into the allowance for doubtful accounts. So now it's still an asset. Okay? It's still an asset. Now, again, let's say fast forward, it is March, and this guy still hasn't paid us. So unfortunately, there is no other way to just be able to write off the bad debt. You would actually have to, if you're going to do it, you would have to create what's called an adjustment entry. Okay? So how do you create an adjustment entry? Well, that's pretty straightforward. All right, you go to your company and you have the option to create a general journal entry. So again, we will take a more good detailed look in this in chapter 14. Okay? And what this does is it makes adjustments at the end of a given period. In this case, right, I want to make this available as of March, let's say 31st, since it's usually at the end of the month anyway. So that's a full 5-6 months that Mr. Tim did not pay me. And again, you're going to make this reference as, once again, 2021-1, whatever reference you want to make it for this journal. Okay? Now, in this case, they teach you to place the journal entry into journal entries bank account so you can always pull up this information at any given time. So again, that's just something I will teach you in chapter 14, but I'm just going to do it for now. And this is how you're going to do it. Since we have a bad debt expense account, right? That's exactly what you're going to do. You're going to associate it and link it to a bad debt expense account. And you're going to credit your allowance for doubtful accounts. Okay? And you're going to drop that 190 in there. Okay? So once again, 190. Okay? And again, what you're going to do is to write off bad debt. Okay? You're going to copy. You can use the copy and paste tool in here. Okay, so Control C, Control V. No name is necessarily there. You don't need to bill anybody. And the class, again, it's subject to if you want to make that association with your income and your expenses if you want to separate them. Okay, so here this is what I've confirmed. Tim is not going to pay me. Okay, so I'm going to write him off as a completely bad debt as of March 31st. Okay, and I'm writing him off for that whole entire $190. So once I do that, I click Save and Close. Okay, so that's called the adjustment entry. And let's take a look at my chart accounts one more time. My account for the allowance for doubtful accounts, it's now 0 because I removed him out of this company. He's gone. Okay. And then if I scroll down and click that bad debt expense account, okay. Notice this. There's one credit memo and then one general journal entry. And look at this. I moved Mr. Tim's amount that was a potential bad debt for $190. And boom. There it is. And that is how, if you are going to be a regular accountant, okay, a general ledger accountant, whatever kind of accountant that's not a tax accountant, this is the steps that you have to do. Now, is this going to be on the exam? Absolutely not, because the program is geared towards tax. But what I'm teaching you here is something that will happen in the future if you do not become a tax accountant. Right? Any questions here?
Yes.
Go for it.
You said bad debts and doubtful accounts.
Mm-hmm.
IRS in bad debts exempt 5%.
That's
Of
for for corporations and any businesses. Yes, that's what they allow you. You can't do because if you do more, then you have to write that off as like an actual loss. So basically, that 5% margin is what they forgive you for. Yes.
And for doubtful accounts,
Mm-hmm.
no percent.
In this case, the allowance is the same thing as bad debt. It's just one is potential, and eventually it becomes bad debt.
Thank you.
Mm-hmm. All right. Any other questions?
So you eliminated the 190, right, from your books?
Correct.
Okay, so why is it total 380?
I'm sorry?
Is it total 380?
Oh, right now, yes, because we've been hold on, let me see. It's because we the first example was I was showing you the direct write-off method, right? The second example was the allowance method. So yes, in this case, the total is 180, yes, or 380.
Okay, thank you.
Mm-hmm. Okay. Again, this isn't in your book, okay, but it's definitely something, if you jot it down, or again, this is recorded, so you have this example for you to carry on into the future. Okay. So you actually know how to do it. All right. Any questions? Okay. So I am actually coming up to 10:07. So let's go ahead and take our break now. Okay? If there's no questions. So in this case, it is 10:07.